to be able to, there we go. Then I'll share my screen and we'll get on to the slideshow to kind of guide our first investor mastermind here. All right, can everybody see it?
Yes.
Fantastic. All right, so to kick off, obviously a lot of you guys probably found this over on Bigger Pockets. I think that's where a lot of us had the chance to kind of meet, is through that environment. Obviously, free, investor friendly kind of resource for us. For the people who didn't just hear my preamble before this, like super excited to have this be the first like hybrid mastermind for anybody interested in the Milwaukee area. How's it going, Aaron? We're just getting started. And we'll keep going. So pulled up. So like I said, first one, this is going to be like our first rough agenda here. Maybe we'll evolve this as it goes on, hope to, get us together at least once a quarter for anybody interested in investing here in the Milwaukee area. We've got, 4 of us here in the office. We've got a couple people here in Milwaukee that are live, but a couple people across states. So I'm super excited to kind of run through this. So to kind of kick us all off, we're just going to have investor introductions, about 3 minutes per person, because we do have relatively, just about 10 people. We can maybe spend a little bit more and dive and ask people a little bit of questions here and there. That's totally fine to, dive into this a little bit deeper. In case we have large accounts in the future, we'll have to be tight on time. This is kind of the layout. I'll go to the next slide and I'll have this in bigger.
I just lost your audio, Ty. Did anyone else?
Yeah, so did I.
Yeah, likewise.
Yeah, we don't need Ty anyways. I can take over from now. Just kidding. I'm sure he can hear me.
Well, we lost the projector screen, right? You guys can't see that anymore?
I can hear you though.
Correct? Screen is gone?
I see the computer.
You can just see, you can't see the whole office anymore though, right?
No, correct.
All right, well, Willie's going to figure that out. I'll just keep on rolling on this computer. I'll turn my volume up. And this is to be expected in the first one. So we'll toss it up here. We can still see everybody. You guys can still hear us. We can still hear you. So if we can figure out the technology, we'll keep going on that. All right, back to this again. And then I think the big part of like any sort of, investor kind of like mastermind we have here is, what do you need to make yourself more successful in your, ventures here in real estate investing? And then also giving back to the community and everybody we got here in this room. How can you help out other investors? After that, I did pull together, some slides here for the Milwaukee real estate market update with a little bit of like a duplex focus as well. That's something I do every single month. So I'm happy to kind of run through kind of like the abbreviated version of that. And then before I go too far, I'm also going to put like, I guess we have a smaller group. So question and answer, I can open up the Q&A thing and actually have it so you can type in questions as we go. So we're not interrupting people, or we can just save our questions and kind of just like have an open discussion for whatever time that we have left over. So with that, I'll kick us off. Just to give us a little bit of a template here. So I'm Ty Ash. I'm originally from Ankeny, Iowa. I now live here in the Milwaukee area. I've been here for about 7 years. In terms of strategy, I got started with a house hack back about 5 years ago. Live with my fiance now. We did another house hack after that. It was supposed to be like an Airbnb sort of strategy. So like we're really using like owner occupied strategy. And now we're living in like a live and flip is kind of our current strategy. Also got like a few long-term rentals in the Des Moines, Iowa area where I'm originally from. Needs for me, I definitely just need sellers, need some opportunities because we got a couple house hackers here locally. I think everybody's just hungry for inventory, and the market update is definitely going to present to you guys why it's the case and why you get so frustrated when you can't find yourself a deal. So in terms of how I can help other investors, I'm an investor-friendly real estate agent. I've got all the contacts you need, whether it be lenders, contractors, whatever else might be to help you. Any sort of landlord resources, obviously a lot of those you can get for Bigger Pockets, where I've got, that membership and everything there too. So a little bit about me. If you guys don't mind, we'll just kind of go through our room here, and then we'll go to the people online, because we can't currently see you guys because the technology's working. So then we'll like hop off the slideshow so you guys can kind of like, we can put a face to the name and the information. Sound like a plan?
Cool.
Yes.
You guys still hear us okay?
Yep.
Awesome. Well, Willie, let you dive in.
I'm Willie. I'm from the Milwaukee area here, born and raised. Strategy, boy, I'm still pretty young, so I'm still looking to get my feet wet. Me and a good buddy of mine have gotten pre-approved and have looked at a couple places, but our struggle is just that we're pretty young and don't have a ton of cash, so we need something that doesn't necessarily need a ton of work. But based on my current living situation, I'm getting pretty serious about looking and finding a place, hopefully by the end of the year or shortly thereafter, because otherwise I'm going to be living with my parents. So pressure on me. And then I guess my strategy would be definitely owner occupied, looking for a duplex. What was the other thing? How can I help other people? I work with Ty, so that's how I can help you. Pick up some stuff from just hanging out with him and absorbing good information that he has to learn and or offer and stuff like that. So yeah.
Awesome.
All right. My name is Nick Vogel. I'm from Richfield, Wisconsin. Lived here my whole life. I went to school in Grand Rapids, Michigan, so I was in Michigan for about 4 years. And I'm just new to real estate investing, like Will said, and just trying to get started. Haven't bought a place yet. I'm looking at doing a house hack with my fiance, and we're trying to buy something towards the end of winter, early spring area. Currently living at home with parents, so just stashing some cash to get ready and start the real estate investing times. And then how can I help other people? I mean, right now I'm pretty young, so if you just want somebody to talk about properties with, I'm definitely more excited, but hopefully in the future I can definitely add some more expertise through experience, stuff like that.
I'm Tyler Wenzel, originally from Janesville, Wisconsin. I literally just moved to Milwaukee chasing a girl. I sold my house. I just got a triplex under contract last night. So currently what I'm meeting is someone with more experience than me. I come from BP, I guess. So I've definitely been doing some due diligence on, listening to podcasts, reading a bunch of forum stuff, reading tons of books, all that stuff. But we'll see how good I actually know what I'm doing. So I'm glad Ty's here, Charlie, Willie, all these guys. It's good to have someone to bounce ideas off of. I am a commercial plumbing foreman. So if anyone has any plumbing questions specifically, or even general construction questions, I may be able to help you out. So reach out.
Awesome. Thanks, man. Well, I'll pull down the slideshow so we can see everybody on the virtual side here. I'll stop presenting my screen so it's not mirroring. Yeah. So I'm just going to go from top left corner for me. And so that's going to be you, Rosanna. We'll let you kind of on the virtual side and introduce yourself.
Okay, so my name is Lina Rosana. I'm from Colombia. I own 2 properties there. I live in New York. I own 2 properties here. I'm kind of new to real estate in this country. I have been a landlord or a landlady for 2 years now. And then prices have gone up a lot in New York. So now I'm trying to learn about the market in other states. And I guess if anybody's interested in New York, I do have some contacts for the lawyer that I have used, realtor and contractors.
Awesome. All right, Joe, you're next on my list here.
Hey, everybody. My name is Joe Hulljack, and I'm originally from Milwaukee. I grew up on the north side of Milwaukee, up from 89th and Capitol, and I've been investing in rental properties on and off pretty much since I was in my early 20s. I currently have, right now I have a partner that I do this with, and right now I think we have 9 buildings. Sold a couple of them recently, and you know, I met actually Ty from when he did his first house hack a few years back when I did the financing on it. I don't even remember how we connected. I think Charlie, you may have referred me to them, or I don't even remember how it worked out.
So we literally just Googled. So I was just one of your classic Google leads giving you a call. So
is that what it was? Okay.
Yeah.
Yeah. So it's kind of in the relationship is taken off from there. And really for me, like I just like to really kind of talk to people and join, these types of forums here, just because, no matter how many properties you own or how long you've been doing, you can always learn something from somebody. And it's just kind of cool because, I have young kids, married, so my life I'm pretty much like a robot, right? I get up, it's the same thing every day, day in and day out. And to actually like interact with other adults is pretty cool. You know what I mean? As far as like how I can help, I'm, like I said, I've been on the finance end of it. I've been doing it my whole entire adult life, pretty much right out of high school and through college. As far as investing in real estate, I've set up LLCs and have contacts to, pretty much the same as everybody who has been investing for the most part. So a lot of times it's cool where you can kind of, bounce ideas off people. And if my guy's not able to get out and do whatever rehab, I may be looking for, maybe one of you guys or vice versa. So I think, again, I just, I like to try to help with what I've done, over the years, and hopefully help other people avoid the mistakes that I've made, because Lord knows I've made a lot, but that's how you learn. So that's it.
Awesome. Thanks, Joe. We got technology up and running again here. So I'm going to screen there. Can you guys still hear us now that we pivoted to the other screen?
Yep.
Yes.
There we go. And then I'm going to go back to sharing our slideshow so people don't have to go off memory after the questions I put together here. All right. I believe next on the screen. So now I'm going to change it up a little bit. Charlie, you're up next on our screen of people who haven't chatted yet.
Yes. Hello. My name is Charlie. I have been a real estate agent for over 10 years now. I've been investing for 6 years. I grew up in the Lake Country area of Wisconsin, or just west of Milwaukee, about 35 minutes. My strategy, all of them, house hack, burr, hard money, fix and flip. I've done a handful of these. Needs, I don't know, bring me a property, bring me something that looks sexy or something that doesn't, and let me make it sexy. How I can help other investors. I've been selling real estate for a good amount of time now, but I think the way I can truly help you out is if you are questioning whether or not you should buy something, I'm going to give it to you straight, and I'm going to be able to tell you, or I will tell you, just do it. Just buy the house. What's the worst thing that could happen? Like, stop waiting. Like, get off the fence. And if you need someone to kind of push you a little bit, give me a call. I will push you. I will push you to just buy the property.
Sounds like a good real estate.
Willie, quit waiting. Buy the property. Don't move in with your folks. Your folks. I know your folks. They're nice people. Don't do it.
I'm surprised that your need wasn't highlighting that you're trying to work on that leasing up that commercial building, and maybe some people would know some people to go fit into it. But
I should have. I have a property in the Harbor District of Milwaukee. If you know someone who's looking to lease commercial space, we are redeveloping the property. There's a need.
There you go. All right, Jeff, you're next up on our screen in terms of the order here.
Okay, can you hear me now?
Yeah, absolutely.
Okay, yeah, I was just on mute. Sorry, I was a little bit late. I just got off work. My name is Jeff Parkin. I live in Schaumburg, Illinois, actually, which is about an hour 15 away from the Milwaukee area. Um, I actually kind of have to live around here because my current situation is I have a son who is disabled and lives in a group home for people with disabilities. And my stepson also lives in a group home for kids with disabilities, and state of Illinois pays for it. So my wife and I are kind of staying in Illinois where we get the private or the state funding for that, which is a nice situation. So that's why we stay here, but we like the Milwaukee area. We've kind of just discovered Milwaukee. I grew up in Illinois, this area, moved around. I lived in Florida, Ohio, and Texas, and I still travel to Texas regularly, about twice a month on the weekends. But we just kind of went up to Milwaukee a couple years ago and just kind of fell in love with the area, and we just love all the communities of it, and nice, clean, safe area. And we go, if we're going to be doing some investing, because we're both a little bit older, we're 50 years old, and kind of looking for retirement planning, more than just a 401k. We thought we'd invest in some properties. So right now I'm looking Saturday, the second time at a foreclosure property that's going into foreclosure, bringing out a contractor, bringing out my partner, lives out of state. He's coming with, and we're going to be looking at that. So what we're primarily looking at is some duplexes, triplexes, but right now we're just getting started with our first one. And some of the things I can help with other people is, if this goes well, I know some people that are looking to invest money, because like I said, I know some friends who are a little bit older, a little bit more established in their lives and their careers, and they're doing okay. So they're looking to bring some money to the table if this first deal with us goes well, and then have no problem partnering with other people. And I'm also not afraid to swing a hammer or two. Actually, it turned out during COVID, I remodeled our whole place, and then remodeled my in-laws' place. And they're like, "Why don't you get your own place and kind of remodel that, as an investment property?" I go, "Okay, yeah." So that's kind of how that idea kind of got started, and been on the Bigger Pockets, listened to podcasts, read the books, and everything like that. So we're getting excited about it. Like I said, we've been working with SUV properties. With them, and like I said, we're going to look at the place for a second time this weekend and see what kind of comes from that.
Fantastic. Thanks, Jeff.
Yeah.
Aaron, you're next up on our screen. If you can unmute. You're still muted.
That's
There we
step
go.
one. There we
Now
go.
we're
Can you
talking.
hear me? All right, I'm gonna
Yeah,
make
we
this
can hear
really
you.
fast because I have a ticking time bomb right here. So I'm on baby duty. So I'm gonna keep this quick. Hi guys, my name's Aaron. Ty, thanks for putting this together. Also thanks for throwing that slide up because there's no way I was gonna remember those. So name, Aaron Anderson. I live in Southern California. That's where I am right now. I'm originally from Washington State, like Seattle. That's where I was born and raised. So I'm a West Coast guy, but I'm moving my investing to the Midwest now, which is why I guess I'm on this call. I'm chatting with Ty. I found him through Bigger Pockets. He's been totally amazing. So a strategy. So I started with house hacking. That's how I got into this whole thing. So I picked up 4 houses over here via house hacking, and then our kids got older, and I was like, I'm not going to keep moving into houses. This is getting more and more difficult. So we got 4 good houses that way. 2 of them were duplexes, some were single family homes. And I'm sitting, literally just sold 2 of them before the market kind of started to go down. Was like, let's cash these puppies out. And in the process of moving that money, I have a 4-plex that I'm going to close on Friday, actually, using that 1031 money over in Cleveland. And I'm working with Ty to hopefully place some of the money in Milwaukee. But yeah, so that's my personal portfolio. In addition to that, I've got really fallen in love with, I guess, multifamily. So I teamed up with one of my friends who's in Michigan, and she started doing multifamily a couple of years ago. So we teamed up to syndicate a 32 unit in Detroit. And we just put in a letter of intent for another 30 unit in Michigan that we hope to do a condo conversion on. Yeah, so that's kind of where I'm at, as far as I guess my needs. I'm a team builder. I super respect all you guys that are I can work a hammer. I can work a hammer. I don't want to work a hammer though. I'm way more into creative finance. I love talking and work with lenders. No joke. I literally talked to 8 today, and I'm always trying to kind of build those connections so I can kind of creative finance my way through a deal. I just got into Pace Morby's sub 2 course. So I'm going to try and get deeper into seller financing and that type of stuff. So anyways, so I think needs for me is like deal flow. I just need to increase the, the good deals that are coming my way. So anyone who like has deals, I love chatting that through. And then, yeah, how I can help is just like, I'm trying to build my investor pool so I can bring capital to the table. And I'm getting more and more familiar with markets, slowly getting more familiar with Milwaukee, thanks to Ty, really familiar and have a team in Cleveland now, starting to kind of warm up to St. Louis and just like, yeah, wherever there's deals, I'll kind of like start to poke around there. And then Michigan, we have heavy presence in Michigan. So, okay, I tried to keep that quick. There we go.
Awesome. Thanks, sir. Isaac was texting me, and I think that he's just listening in. I think he's busy tonight. So, Isaac, come off mute if you do want to introduce yourself. Otherwise, we'll come back in person because Nick came in a little bit late. So I'll let him kind of take the floor next.
Yeah, me?
Yeah.
Well, Ty.
Oh, sorry. Yeah.
Okay.
Sorry.
Can everyone hear me okay? I'm kind of far away from the microphone. Yeah.
Yeah.
Thanks for putting this together. Nick Harrington. I'm from Des Moines, Iowa originally, but now have lived here in Milwaukee for about 4 years, I want to say. I actually worked with Charlie. Charlie Hutchinson is my realtor. So he's helped me buy 3 different places here on the east side of Milwaukee. Started with a duplex that I was living in. Another
Did you hear that,
duplex
Ty?
I'm also still living in.
Ty, did you hear that? He said, I'm his realtor. Just want to make sure that you heard that.
For now.
Yeah, Charlie, realtor for now. And then I have a 5-plex that I just purchased earlier this year. So we're up to 9 units. My strategy is really all about finding deals that there's a discrepancy between where rents are now and where they could be. And that's a big thing that I've been focusing on, is trying to find a good purchase price, increase rents through some minor rehab, and eventually just have equity right in there, but also have cash flow short term. Biggest needs, I am at the point where 2 things, debating doing an Airbnb and short-term rentals on either an Airbnb or a Vrbo. So if anyone has experience starting that, advice to it, that's kind of the next step that I'm thinking about doing. And then also, I feel like I'm at the point now where I've got 9 units and it feels like it's going to be very difficult to get that next property just from like a down payment equity perspective. So if anyone has thoughts on like investors and what strategies work for you as far as pooling investors or creative ways to come up with money, how I can help other investors, I would say I pretty good at running numbers, know the Milwaukee market really well. I'm not an agent myself, so Ty and Charlie will know better than I do. And I would say I'm a newer investor also. Been doing this for about 3 years. So if you're looking for someone that's maybe newer to the space that doesn't have like 50 units, might be overwhelming to talk to them, I would say that's how I can help as like a first-time investor probably. And Charlie, you are good at pushing people. I remember we probably saw 3 different properties, and then the first duplex I wrote on, you were like, dude, just do it. And it was the best decision that I've made. And I don't know if you were there, if I had someone else I was working with, if I would have purchased it. So
Because do the numbers work?
the numbers worked.
Yeah.
They really worked.
In case anybody's looking for a narrative about Charlie, he, and I quote, when I bought my first house hack with Charlie was my first agent when I was in the Milwaukee area too, for my house hack. The words that he said was, if you don't buy it, I will. So that's how I knew it was a good deal, because he was putting his money where his mouth was, or if that's the right way to say it. So that's kind of all the interest here. I mean, I'll definitely take a pause. Obviously, we kind of just went to fire around through everybody doing introductions. Did anybody have any like further clarifications on, hey, something that you can help somebody with, match somebody's need? Feel free to raise your hand or go off mute if there's like something that like caught your eye or something like that that somebody could help out with.
Yeah, I got one thing. I forgot to mention, I'm a CPA and I work in specialty tax where I do R&D, and the other part I do is cost segregation. So I do, obviously, real estate cost segregation is a big thing. So if anyone has any question about cost segregation, that's what I do for half of my job. So I hope you got a little plug there.
Cool.
That's a good one.
I get a CPA. Yeah. Yeah. Did you say you're a inspector?
No.
Oh, okay, yeah.
I kind of split my time. Half my time I spend with Charlie and Ty, helping kind of manage their deals. I work as their kind of transaction coordinator, doing a lot of behind the scenes work. And then I also work as a home inspector here in Milwaukee. So I've been doing that for about 4 years now. So, you know, can do a home inspection, or like I did Nick's property, and you know, he'll come in and talk to me about stuff about, you know, what he should do about this. Is it something that can wait or whatever? So I see a fair bit of homes in Milwaukee, so have some good insight from that side of things.
If you got something funny looking in Milwaukee, just shoot me a picture and I'll send it to Willie. We call him the deal killer. So
If you want to have a really good time in a basement, you give Willie a call, because you'll be down there for a couple hours looking at all the mechanicals and the foundation.
That's good to know, Willie. I didn't know that you're an inspector. I mean, we've hello, by the way. I forgot, I didn't even say hello to you earlier. But
No worries, no worries.
idea.
Good to put a face to the name, Joe.
That's funny. I had no idea that you are, but I'm glad that I know that now, because I can definitely throw some more business your way on the inspection side of it.
Yeah. Oh, we should connect for sure.
there you go.
Yeah, I'd
Anybody
be curious to get a hold of you too, because like I said, we're looking at this one place, getting a contractor out there, and I'm trying to tell them, hey, you got to get this up to code. You got to fit, kind of going, what needs to be fixed, and want a home inspector to kind of check it out too.
Yeah,
So-
and I'm with like it's actually a national company, and then we have I work for a franchise here in Milwaukee. And what's unique about us is, so we have 3 guys, so we'll bring all 3 of us if need be or whatever to really shorten that inspection time. So we'll take on bigger unit places that a lot of other solo inspectors can't touch. Like we did this summer, we did like 100 unit place in Milwaukee over the course of 3 days and stuff. So we see it all.
Okay. Yeah, I'd be interested in getting your contact info.
Yeah, certainly.
Yeah,
Cool.
Yeah, make sure, I think everybody's got my contact info. Like I would really appreciate, just like as we kind of have a break here, make sure you text me that you attended today, because obviously I've met all of you guys. I know all of you guys, but I have a bad memory of who all showed up. So please send me a message so that I can kind of do a summary of what we kind of talked about today, as well as just connecting everybody with each other's contact information. Because that's the whole goal of this, right? Is to, make sure that and I can try to put the clip notes of who said what and what they do, like inspections and lending and all that kind of stuff. So
Who's the CPA? Yeah, I got a question for you. Cost segregation. I've been hearing a lot more about that. When's the right time to do that? Is there a specific type of property? Is there a time when you buy the property? What are the details there?
I'd say if you listen to some other people that listen to some stuff about cost segregation, I'd say anything over $500,000 purchase price definitely want to look into. The problem is if you go under $500,000, if you go to an actual CPA firm, if you go to some other firms, it might be cost benefit to get it done versus the benefit you're gonna get out of it might not be as much. But some of the companies, the company I work with is CLA, and we don't have a template. Some companies developing templates where you can just plug in numbers. Say you have a $200,000 multifamily house, so let's plug you in a template for $500, something like that, and they'll spit you out a number. But if you really want an in-depth one for anything over $500,000, I'd say the best time to do this now, especially with bonus appreciation going down to 80% starting in 2023. So if you want to capture as much benefit as possible, 2022 would be your best year. Other than that, I'd say when you have more income and you're trying to offset that income with your depreciation, so it's definitely another good side.
Can you explain what that is?
What cost segregation is?
Yeah.
So cost segregation, what we do is we look at your building. So say right now you're depreciating your building at 39 or 27.5 years, all your purchase price. So what we'll do is we'll come in and we'll get your plans, get your appraisals, go in and walk through your buildings, and we'll take out anything that's 15-year property or 5-year property. And 5-year properties mean all your furniture, special flooring covering, special lighting, cabinets, and all that kind of stuff. It's gonna be 5-year property. And 15-year will be land improvements. So basically, if you have a driveway or if you have an asphalt parking lot, that'll all be 15-year property. Trying to think, fencing, special, and another part of 5-year property is like special electrical. So like if you have a garage door opener, like that special electrical going there, special plumbing, all sorts of different stuff that you don't really think about breaking out, but we can do it. And I'd say that that's about
What is it like the benefit of it though?
so the benefit of it is like, well, so what we'll do, you're appreciating 39-year property, say $200,000, you're only appreciating, what's that, like $20,000 a year. We'll come in, do a cost segregation, and you'll pretty much get a $60,000 write-off almost straight off the bat on your tax return in that year.
Gotcha. Okay.
My understanding for a lot of people that as they start having momentum in their portfolio, or maybe they've got a great W-2, is they can get a lot of the tax savings and invest that into another deal each year and create a snowball of they're saving money on taxes and putting that into a down payment on another property.
And that's your W-2 income is what
It won't offset your W-2 income unless you're a real estate professional.
Okay.
But when you said you go on the Airbnb side, I think it's a whole different thing. You can qualify through Airbnb being offset your active income.
Okay.
Through being material participation, as long as your Airbnb is less than 7 days,
You got to manage your own property.
and you have to manage your own property. Main ways to do that is by more than 100 hours and more than anyone else. So basically, if you have a property manager, you probably won't qualify for that. But
Okay.
if you're doing Airbnbs and you have a few of them, like definitely a good idea because you offset that W-2. And if you're trying to real estate invest and you're trying to scale, like I don't understand why you wouldn't want more cash in your pocket now because you make it work and your investment's even higher.
Cool.
Like how we project things out is using an 8% return interest rate, but if you're going to real estate, I'm expecting you're definitely going to be more than 8% return. So definitely a huge benefit with cost segregation.
Yeah.
What if you bought 2 separate buildings that are about $500,000 in the same year?
I said do them.
Do it?
Yeah, I said do it.
All right, well, we got to talk.
Yeah, I said I would do the same. I mean,
Because I've always heard that like it's not as worth it if it's a smaller property or whatever, but I guess if you're
it's all based on the fee what we do, and like if my company can't offer you the best fee, then I would say definitely try to find.
does that have to be here in Milwaukee or is it?
No, I mean, the farther away you go, the worse it's going to be because a lot of people are going to want to come and look at your property. So if you're trying to say you pay someone, if they're charging like per hour and their billable hour for like CPAs are really expensive, and they have to come to your property, come look at it.
It's in Iowa.
Yeah, so if it's in Iowa, yeah, I'd say, or you find a company that has offices across the nation. Like my company that we're working with is like we got companies across the nation. We're 8th biggest accounting firm. So I'm doing a project right now that we're working on in Rhode Island. So
Okay.
I've hooked up my guy in New Jersey, and he's going out to look at that one.
Okay.
I'm doing another one right now in Florida, and got the Florida people going. So it saves a lot of money on the client side, but also we're able to do whatever. So
Okay. Cool.
yeah, that's a little snippet on cost seg.
Nice.
Anything else that came to mind? Questions right now? I was going to say questions at the end, but this kind of feels like a nice time to bring them up. Anything else that popped up as we kind of went through? Cool. All right. Well, next up, what I got here. So not really knowing like, how many people are going to come on here. I want to make sure we had like something else of value to kind of run through for everybody in here, real estate investing. So each month I go through a real estate market update that kind of covers some of the national headlines that you might be seeing and how that actually relates here to the Milwaukee real estate market. And then I usually give a little bit of commentary, probably like 1 minute commentary in that update on YouTube that actually talks about like the duplex inventory and then goes into what it means for buyers, sellers, all that kind of stuff in my take. So I'm going to go through some of those slides here again. I do like a 15-minute version. I'm just going to kind of go through some of like the cliff notes of what that is. I just went through this data yesterday, and it probably won't be posted on YouTube until sometime next week. But I think this is super helpful for anybody that's a real estate investor. And I'm hoping this kind of brings up some helpful conversation as well in terms of other people's thoughts on the market, especially because instead of me talking to other Milwaukee real estate investors that feel the same way because our market is our hyper local market, what are other people seeing out there? I know I've had conversations with Aaron where it's like, it's a completely different, yin and yang in terms of the different markets out there and stuff like that, being out on the, Washington area. So kind of start off here, obviously in the headlines we're hearing, inventory's climbing, people are dropping price everywhere. So starting with like the housing inventory, 753,000 homes available for sale versus last October, 564,000 homes. So that's a 33% increase in the national inventory. Those are stories you're hearing. Obviously, usually you just see like that percent change, there's so much more inventory than a year ago. But let's look at this next bullet point here. For in our historical context, we're down about 40% in inventory, nationally speaking, compared to 2019. And if you listen to like a bunch of people, there's some great, analysts that are like on Housing Wire. If you want a good podcast recommendation, nationally speaking, that was like the last time that we had inventory at around 4 months of supply, which is considered like the very bottom line of like somewhat balanced market where we have a functioning real estate market. So down 40%, pretty big number in terms of the national metric. But then what even crazier here in the Milwaukee market, active listings are down 23% to last year. So that's your single family and condos in the Milwaukee 4-county area, as well as duplex inventory. So probably something a lot of us are kind of interested in, down 55% a year ago, which is obviously, which is practically nothing. You'll see kind of like, I actually have like the actual raw numbers on a future slide here. It's, active inventories in the low like 100 range. So
on the first bullet point you have, are you saying that national home sales are up from a year ago?
No, so that's housing inventories on this page. Yep. So that's 753,000 homes available for sale to inventory. Yep.
Okay.
So that's, last year there's only 564, obviously a housing shortage. You still look at right now, like obviously you see a change, but when you have such a low base, seeing high percent change in inventory is not as jarring. But obviously the big important thing is we can't just talk about real estate in a national context. It's great to have a baseline for what's going on. You have to really understand your hyper local market, and that's almost down to the neighborhood level of what's really going on. And that's where a real estate agent kind of comes into play. Let's see what I had next up. So this is just the chart. So, pretty much all the data I always pull comes from the Fred website. On the very far right-hand corner, you can see that 753,000 homes, and you can actually see on that chart right about the middle of the page, right around July 2019, like that's the inventory numbers that a lot of like the, analysts are looking at in terms of when is this market actually going to return to some sort of normalcy in terms of functioning with, buyers want to buy, sellers want to sell, and there's like a negotiation, inspections are normal, there's not this crazy overbidding. We're, like almost halfway there. It's great to see this nice trend line of homes coming to the market, but depending on the market, we're still seeing lots of competition. So that's the national perspective there. Other thing that I cover other than just like the active inventory nationally speaking is the inflation update, because that obviously has a huge impact on what the Federal Reserve is trying to curb. They're going to make changes on interest rates, and that keeps on trickling down into things like what's a safe investment. And right now that's not really mortgage-backed securities, because pretty much the first thing that people are going to do as soon as rates drop is they're going to refinance out of them. The good news is obviously we peaked, back in June at 9.1% inflation. We've seen it come down each month. And this was actually the first month in October where the inflation rate came in lower than what the expectations were. So it doesn't matter so much what the number is on the screen, more so what everybody's expecting. And when you do better than that, that's why, Joe, who's probably the most familiar with this, that's why we saw such a good reaction on Friday. Inflation update came out on Thursday. Friday, we saw a little bit of, positive momentum in mortgage interest rates dropping by like 55 basis points. So just a little bit on the inflation. This is kind of like the under the covers look here. They look at, all items. So 7.7%, like you saw on the previous page. Then you got your food, which is a little bit covered up here. I think it was somewhere around like the 17%, or I think it was like 13%, whatever. That's food you buy at the grocery store. That's food you buy when you're going out to eat. Energy levels, obviously the highest percent change compared to a year ago, driven by, world events right now, war. This is not only the gasoline at the pump, it's also your energy as, at your home, as well as your electricity bill. And the very last one, even though it looks like one of the smallest buckets on the page, the all items minus, food and energy, that includes, commodities such as the things you buy at the store every day, TVs, all those different things, clothing. It also is like services that you pay for. So, that might be, transportation stuff, but also shelter. And inside this bucket, even on this page, this is showing percent change. It's not showing how large it is as part of your total inflation basket, the CPI data. And what's in there is shelter, which is about a third of all inflation, which is sitting right around 7%. So really shelter is really just, what is the leasing activity out there? It's not, the cost of people who own their home. And what we've pretty much heard in the news is a big driver of inflation is how much rents are going up year over year. And there's a lot of stickiness to that inflation of shelter costs because it's on a 12-month leasing basis, right? For most of us here, we know leases kind of happen on a 12-month basis. So there's some stickiness there, and that's why we're seeing such aggressive action by the Fed. Obviously, they're aware that, inflation has some stickiness because of that, shelter cost in there, but it's finally good news that we got that 7.7%. Questions on the inflation piece of this? So like I kind of mentioned, so inflation kind of tied with what we're kind of seeing in the rates and that huge spike over time. This is the app that I follow, the Mortgage News Daily. Obviously, usually Joe is crushing this top left number. So if you're thinking 6.67% feels good, Joe's probably going to do even better for you. And what the main thing I pulled up on the screen is that 55 basis point decrease in one day is a pretty sizable decrease, mostly just because of that good news that we had back on Thursday last week. And typically, this is probably a little bit lower than what we're going to be seeing in any sort of investment property. So this is more for your owner occupant percent rate. So a little bit of an eye chart that I got for you guys here. Now this is, dating, essentially this is this entire year. And what we have on here is 30-year fixed rate mortgages, as well as the 10-year treasury are the two lines I'm focused on. So we've got the blue line that on the far left starts at about 3%. And then there's a red line, solid red line below that, that's right around like 1.75. So usually interest rates are tracking along your 10-year treasury, because that's like relatively the safest investment that investors can make is investing in a 10-year bond backed by the US government. And typically we see a spread, I think it's somewhere around like a 1.7% or so between that 10-year treasury and the mortgage interest rate. So I guess in this case, it's like 1.3% is where we started this year. But you can see that spread widen as we go from left to right, and we get to the month of October. Now that spread is almost double the size. And that's why we can see a snapback in the interest rates in one day, is because lenders have been pricing this in for months, because the Fed communicated and showed, hey, interest rates are going to go up. We're going to keep raising interest rates in total. Okay, that kind of leads to this like wider spread in interest rates. Joe, anything that I just totally botched in that conversation, I'm going to put you on this. Let you talk about it.
No, not at all. I mean, this is good information, and I actually wasn't even aware of this Fred website. That's a new one for me. As far as going back to when you were quoting about showing those rates on that last screen, a lot of that, a lot of times when you see rates being advertised online or wherever, what they don't really talk about in those advertisements are, credit scores, right? So to get the like best possible rate with the best possible, lowest possible cost, you're really looking for like a 740 credit score, primary residence, single family, right? So when you fall into the bucket of buying a 2-unit or 3-unit or 4-unit, whether you're going to live on it or if you're not going to live in it, that's going to determine, where the rate's going to come in at. Loan amount is a factor as well, but this is all really, really accurate information.
Cool. I'm not making it up. All right. And as we talk about inflation and then the interest rates, everyone's wondering, right? It's like, okay, is it going to be stuck like this forever? Are we going to go all the way to the moon on interest rates? The biggest thing that we're hearing the analysts say right now is the biggest thing that the Fed is watching to finally break. They've already pretty much broke the housing market, which they said, that's fine. We'll throw all the real estate agents under a table, and we'll essentially create this wide gap between what sellers want to sell for and what buyers can actually afford. What we're watching is the unemployment rate. And typically we see, so the Fed is trying to get us towards getting to a recession. One of the last indicators right now that hasn't gotten us into that recessionary time frame is the jobs report or unemployment rate, which currently sits at 3.7%. If you're curious about Milwaukee, in Wisconsin, we're at 3.2%. So yay for Wisconsin, we're doing great. 3.7% is like just a little bit below what we need to see in terms of getting close to that inflation time frame. So all of these gray vertical bars you see on the screen are recessions. And typically rates are around, or the unemployment rate gets to between about 4 to 5% once like that recession actually kicks off. And recessions are usually determined after they actually are in effect. And what happens when we get to that, we finally see those jobless claims, we see the data soften in the unemployment rate. That's when the Fed knows we can ease up. It's obviously a positive factor that we finally got a good inflation update. Maybe we don't have to have another 75 basis point increase in rates. Maybe it could drop down to a 50 basis point increase for this next time. But then as soon as they've broken everything, then hopefully we can start coming back. And the next question that comes up is probably like, when are we actually realistically going to be able to expect a refinance opportunity, right? Because all this investors are trying to run our cash on cash, our return on equity based on today's interest rates being around 7% over the last couple of months. Like we have to run in our pro formas when we think about stabilized, cash flow. How realistic is it for us to plug 5% back in? I can't remember if I put it in or not. I don't think I did. But if you look at it's not on this chart here, it would have been on the previous one. That's really hard to look at. 8 out of the last 10 years, we've been hovering pretty much around 4.5% interest rates. Really what happened here is the last, when COVID came in, the Fed just dropped rates, super low rates. We all saw the 3%. They were trying to stimulate the economy. And now they went overboard. Now they're trying to slow it down. And you see this massive increase in interest rates. Well, everyone wants to see it get to a little bit more normalized and be like that 4.5%, 5% interest rate. So we can all have some predictability when we run our math, so we can understand when to buy properties. So that's pretty much what everybody's watching right now, is what the heck's going to happen next jobs report. Because if we can start seeing worse data, we'll be good to go. And unfortunately, one of the markets that's probably going to have the highest layoffs is, tech. We've kind of seen that happening. But honestly, it might be in housing. And us as real estate investors, that's actually terrible, because as soon as they finish all this new home building, that's actually helping our inventory situation. As soon as they finish all of these things that are starting now or under construction, they're just going to wipe out those jobs. They're going to stop their building, and they're going to have to ramp up the hiring efforts again. So just another indicator of this prolonged inventory shortage in terms of the stickiness of our home appreciation. Good chance that it's kind of around to stay. And it's, again, that's kind of hyper local. It depends on what you're looking at. So again, this one's a little bit, smaller in terms of being able to see. This is just the single family condo inventory here in the Milwaukee 4-county area. So mostly areas that a lot of these, us Milwaukee real estate investors are looking at. Unfortunately, it's not in a super awesome order of events from top to bottom, but at the let's start at the very top. So new listings is probably one of the biggest problem that we've had as a result of these higher interest rates. Is most buyers are move-up buyers, or they are, scaling down buyers. They need to sell their home to move into a bigger home for their family situation, or they need to sell, downsize, whether it's, aging at home, moving into a condo, whatever it might be. So a lot of the inventory that gets created is usually for sellers moving on to their next property. Well, if they've got to get an interest rate themselves, they're kind of locked in place right now, affecting that new listing data being down 19%. Almost at the very bottom of the page, that inventory of homes available to sale down 22%, almost 23%, like we mentioned earlier. Not enough inventory that, to be out there. And we see that low months of supply sitting at 2.2. Again, we're kind of looking for that 4 months of supply. Here in Milwaukee, the active listings that we're kind of looking for, we're just under 3,000. We're kind of looking at the 2019 levels. We'd like to see it closer to 5,000. That's about where we were at back in 2019 when we're in a more balanced market. Charlie, I know you're not even looking at the screen. I know, but I'll call you out. Was it a little bit easier to be an agent back in 2019 than the last couple of years?
I would never say that this job is easy, Ty. But yes, in 2019, things were a little bit easier.
So having the options so that you don't have buyers that feel like they're settling just to get into a home is definitely a big driver of what's going on right now. But with all this going on, and now I'm going to go kind of to the middle of the page. So I got to jump around because that's kind of the flow. Yes, we have sales dropping, but we have new listing activity slowing considerably. That's keeping our inventory levels low in Milwaukee. What that leads to is growth in our median sales price or average sales price being up right around 8 to 9%, depending on what metric you're looking at. And this is really the third consecutive year that we've seen 10% growth in price in the Milwaukee area. It's not super sexy. It's not East Coast, it's not West Coast, it's not Austin, it's not Boise, but that actually puts us at the least amount of risk in terms of the prices scaling back aggressively and giving back that market. So it makes it a super stable investment in the grand scheme of the total national inventory, and all the headlines that you might be seeing. So now a little bit more what everybody's kind of looking for. The two family. So again, sold listings, like you'd be like, man, there's so many two families out there. And I'm just trying to get my piece of it. There's like, relatively speaking, there's a very low amount of two families available on the market today. And we're not seeing the inventory supporting the amount of demand that we have. For example, this weekend I wrote on, two different investment properties. One of them had 3 offers, one of them had 6 offers. So, there's, one of those things where everyone's talking about the slowdown. Well, if it's a good asset, and that doesn't mean the inventory that's been sitting out there for 90 days and is overpriced, and Willie could probably attest that it's pretty much just straight garbage. As I kind of go partway down this page, months of supply is down to 1.7 months, almost cut in half from a year ago. And our median days on market is 11 days. And that's like when the offer gets accepted. And you got to remember, that's the median, meaning all those crappy properties out there that are kind of ruining this median. Those are properties here that are actually quality inventory getting accepted offers in 2 to 3 days. Wow. So moving really quick. And this last piece, I always kind of like diving in a little bit undercover. So median sales price, $172,000 for a duplex here in the Milwaukee area, down 4%. So obviously a little bit different for the single family space, but it's always important to kind of look under the covers. We've got a lot of super low price inventory here in Milwaukee that's in the $100,000 range. So if that makes up more than half our inventory, you can kind of see below $180,000 and less is more than half our inventory. Actually decreased less in terms of the number of homes that sold. That's actually a sold metrics, is sold listings down 27% versus our higher priced inventory of Milwaukee being above the 180K, being down further in the amount of sales listings. So that's going to actually mix our price lower. We're probably sitting right about flat if you're to kind of like not worry about that mix issue in the inventory. And that's like a little like snippet of some of like the market update and like what our agent team is kind of looking at in terms of staying informed of the market. Because the biggest thing we want to know is no one wants to factor things like appreciation into their long-term numbers because that's supposed to be gravy on top. But when the supply and demand equation is so terribly imbalanced, it's really hard to imagine that if you sit on the sidelines right now, that you're going to end up winning in the end right now, because prices are continuing to remain very sticky here in Milwaukee. Competition levels are high, and we've got quite a few, out-of-state investors that are still investing here in the Milwaukee market because of the rent to price ratio you can get. And there's a lot of interest in Milwaukee as a cash flow market, which is really driving up those prices. So not just specifically the market update, but like questions, answers, just open discussion. What do you guys got?
What kind of competition are you guys seeing on investment properties? Like a duplex, 4-plex, 5-plex, around there? Are you seeing a lot of offers being wrote on them? If you are they coming in like at asking, above asking?
Yeah, so the most recent one I looked up to, just because Tyler's here in the room, we were looking at like where he should come in at his price. Mm-hmm. The average percent over asking in the West Dallas market, which is like a good C+, B- market here, the average is 8%.
Over ask.
8% over ask on like that quality inventory. Like I had to look at things that actually sold in like the first 10 days on market. I didn't look at just what's the average. I looked at what's the good at inventory selling, like the investments that most of us are looking at, unless we're looking for a total gut job. Mm-hmm. And it's very similar to like kind of what we're seeing in the single family space, like that 5 to 8% over asking on the best inventory.
Okay.
So like a lot of our assets where it's like, we don't want it turnkey. We want carpet, paint, flooring, good projects, some value add. Like that's about what we're seeing. And that's just like one part of our market, but it's kind of a similar story across other offers I've written.
Okay, cool.
Ty, you brought up that the market was going to be slowing down. Home building was slowing down. That is a fact. So my company, Dave Jones Plumbing, we do about 1,000 homes a year, and on top of a bunch of commercial stuff, which is what I do. But we just had a company meeting, and they said that our key metric we use are sewer laterals being piped into a house, and that has pretty much went down to about 0 within the last 2 weeks. So they're going to dry up quick within the next 3 to 6 months, which is typically what it takes to build out a house. So get ready.
That's some amazing inside knowledge right there. I feel like
Yeah.
no one, like the first person to know that it's going to dry up would be the plumber. And so it's
Yeah.
nice to have you in our back pocket.
Jeez. Any other thoughts? And definitely open up to not just like the Milwaukee context. I'm very curious to hear what's going on because I know we've got Arizona, we got Washington. It sounds like we got New York on the call. Like what's going on out in the world that's not, the middle of the country?
I can start with a little bit about Arizona. So as I was saying earlier, I'm originally from Milwaukee, and I all my rental properties are in Milwaukee County, and but I live. My primary residence is in Scottsdale, Arizona, and I do business in Arizona, Wisconsin. From the mortgage standpoint, finance, I do business in Wisconsin, Arizona, and Florida. And from what I'm seeing in Arizona, like. So everybody, kind of going back to what you were saying about how people are, investing in the Midwest, right? It's just, it's more and more of that. Like I was looking at some places out here, and, the ROI on it after the money you got to put into and put down, it's just not realistic. Now, a lot of people that are moving here from California think it's a great deal, right? Because the cost of real estate there, especially in rental units, is on a whole nother level. So coming to Arizona, they look at it as of, from the standpoint of that it's cheaper, and it's, even though there's not much cash flow, a lot of these buyers are buying, just for the appreciation factor, and, obviously the depreciation and the tax benefits you get. But to make a long story short, like it completely makes sense as to why people are investing in, and why these numbers you're showing us with the properties of what's available as far as duplexes now versus a year ago. I mean, everybody's trying to buy them up, and the ROI you get in just other parts of the country, at least from what I'm, like you said, Boise earlier, it's just not there. So everybody's kind of migrating to a certain, the Midwest. But as far as like the way the market is going here on like primary residential stuff here is not, it hasn't really, certain areas, values have come down in certain areas, I think everywhere, but the values are holding strong, and it's still multiple buyers and multiple offers. I mean, it's not the doom and gloom that you hear so much when you listening to the news or whatever. When you're actually in the thick of it every day, I mean, it's still it's one of those things where you just, if you have a buyer, right, that's looking, especially for like a first time investor, right, whether they're going to live in it or not, like you just got to work. It's like anything else, you got to work at finding it, and you got to spend the time and put it in, and it will happen eventually, and it's just becoming a little bit more, the competition is becoming a little bit more, intense, so to speak. But yeah, that's what I'm seeing here. Florida, I haven't done a ton of business in Florida. I've only been licensed there a year. So I don't really, I can't really say that I have my hand on the market there as well as I have it here in Wisconsin. But for the most part, Arizona I'm seeing that exactly that. Everybody's migrating out of here to other places to invest. So anyway.
Yeah, nice to have 3 states covered in one conversation. That's perfect.
Yeah, like I said, Florida, with everything that's going on, when the hurricane, that kind of, I was actually working on a couple deals that ended up falling apart because of that. But yeah, it's interesting to see how things are going. And then it's wild, like here in Arizona where I live, right? So the house that in my neighborhood where I live now, right, I had a house that I had back in Wisconsin in Pewaukee. I lived in Pewaukee for about a decade, and I bought the house in 2005. Actually, that was, speaking of house hacks, like that was like the first house hack I ever did before the terminology house hack ever even existed. It was kind of funny. I bought this house as a primary resident. I moved into it, but at the time there was a bank out of Australia, of all places, that would give you a loan of 100%. It was a home equity line of credit, and they borrow you 100%. So if you paid $300 for the house, they give you a line of credit for $300 grand, right?
Oh, wait.
Right. It's crazy. So
Yeah.
and back then, right, homes were appraising, the whole AMC thing wasn't even hold on one second. My kids just came in the door. It's gonna be really loud. I gotta make sure they're gonna hold on one. So anyway, so I bought the house with that line of credit, got an appraisal on it. I think I paid $320 for it, got an appraisal at $420 turned around and refinanced it at 80% loan to value to get rid of the PMI within the first 30 days. There was no penalties, there was no buybacks, no callbacks, nothing. And it's funny, that was my first house hack. So I paid $320 for that place, and I ended up selling it when I moved out west here in 2018. I sold it for like $370, right? That same house in Milwaukee, if I put that house where I live now, it'd be easily $1 million plus house. So it's crazy, you know, when you speak relative of where these homes are located and what you can get for the dollar. Same example, right? People are moving from California to Arizona and paying, like, what I paid for the house that I live in now is nowhere near what I wouldn't even, like, now if it was right now, I wouldn't even afford to be able to buy it, to be quite honest, right? But people are coming here thinking that it's cheap because of what the costs are out there. So but yeah, I just wanted to tell you my first house hack story. That was on my mind before when you use the terminology.
Yeah.
Anyway, so
It's cool.
Jeff, I got a question for you. You're doing are they the foreclosure properties that you're going to?
Yeah.
How are you
One.
finding those deals, and like what kind of properties have you been seeing? Have you seen anything that's really like came out that's good so far? It sounds like you got one that you're hot and heavy with, at least.
Yeah, how we found it, we were just driving neighborhoods and just driving around areas that we liked, and we found the worst house in the best neighborhood, and that's how we came across it. I've been looking, you know, the West Dallas area, but everything that seems the duplexes that come on the market are contingent. Like as soon as I get an email, it's contingent. It's like, so I got to dig a little deeper and find something that's going to be a little bit more challenge for me. And, you know, I'm going to have to work at it. And that's where I kind of came across this one. It looked, you know, it's not looking real good, but you clean it up and it'll turn into a nice property. So that's just kind of how I came across it. No one was sending me any foreclosures, anything like that. I just kind of came across it myself driving neighborhoods.
Well, that's I know we were talking a little bit about, you know, prices and doom and gloomers, which Joe said, but I also got the foreclosure chart, which was part of, you know, the update that I do as well. So first, I'm going to track down that foreclosure chart. Try to share it real quick, because I think this is like a very good context of, you know, that, you know, every now and then that's a message I get from investors. Can you guys see the foreclosure chart right here?
Yeah.
Like, it's really funny. And this is, I actually got an email from, you know, a lender today. I was kind of talking about, like, you know, some of the doom and gloomer people in the media, and it's like, oh man, foreclosures, they're up 150%. And this is kind of one of those things when you got a super low base, you know, this is 2005 all the way through, you know, Q3, which is, you know, September 2022. I mean, it's great for you, Jeff. You found the foreclosures, but like the either crazier stats. So this is foreclosure starts. So these are, you know, foreclosures at the very beginning of their market. Anybody have a guess in terms of what the average number of days for foreclosure to complete is?
60.
Any other guesses? We got 60.
90.
Like from notice to, I'm sure, like the bank taking
All right.
action.
So not my data, it's Adam's data. 885 days.
What?
So,
Wow.
and that's a lot of really, Joe, you might be most familiar. I know, like, I hear it a lot when we do the signing for people to buy their properties. And every now and then, you know, Stuart Tile will be like, yeah, you know, it's going to take them a while to get there. And, you know, they're going to give you an attorney and all that stuff. Obviously, days are much higher and elevated compared to what they used to be. Part of this is driven by the foreclosure moratorium that happened during COVID. So a lot of that foreclosure data that we're seeing today is literally just ones that got, you know, the can got kicked down the road. And it's a lot of the people that had really soft balance sheets back in, you know, 2019. So you can see, like, there's not a lot of foreclosure inventory coming. So, like, I mean, Jeff, you found yourself an opportunity. You saw there's not a lot of inventory out there. And I think there's a chart in here too that's, you know, completed foreclosures. You know, that's a, you know, pretty minuscule number in terms of foreclosure opportunities coming, and it's going to be a long time even before this, you know, depressed stat of foreclosures happens. And the biggest problem that we have right now is when supply and demand's this out of balance, and we've got tons of equity in homes today, it's going to be really hard to find foreclosure opportunities in the future. That's not going to be a bulk of the inventory opportunities we have. It's going to be people driving for dollars like you are, Jeff. That's a super interesting story you got.
Yeah, I've got another comment here. As I said, I'm in Illinois. I'm a chiropractor in Illinois, and one of my patients that comes in, he's a bankruptcy attorney. He said all bankruptcies, everything's been put on hold for all of COVID, as you know, because of the I forget what they call it. He goes, the courts are so backed up that with all these cases that they're now just starting these bankruptcy proceedings. So he goes, some foreclosures will be coming around because of that, but it's very slow to start. And probably got another, he says, middle next year, probably they'll start really cranking on them.
Yeah, I made the joke in my YouTube video. If you're a foreclosure buyer, I'll talk to you in 2024, 2025 when they come to the market. So
yeah.
So
well, I'm going to try and talk to the bank and just offer them all cash deal and see if they'll go for it.
Yeah, right. The other thing that it's kind of on the same note, we were talking about like the frothiness. This might be a little bit small, but this is just like from my email. But essentially, this lender compiled like essentially the negative comments from, what was her name, Deanna Olick or something like that. I don't know where the heck she works or what she does, but she's like she's their head real estate and climate person. So two interesting things. Essentially, I call her the clickbait expert. Must be over at their firm. But it's just funny, from 2015 through 2021, they essentially just show the stories that she was reporting and the average prices in the United States, and anything to drive clicks and traffic to websites. These are the national headlines that for people that are on the service side of agents, home inspectors, and lenders. These are literally the headlines that people are reading. Housing today, a bubble larger than 2006. It's better to rent than to buy. Next year will be hard on the housing market in 2019. Obviously, nobody knew no one knew that the COVID pandemic was coming. Yeah. And then, middle of last year, foreclosure filings are up 150%. And we just saw that chart. Unfortunately, a lot of the people that we work with, they get the headlines, or they hear it from a family or a friend that have no knowledge of the subject. So it just I thought that was also very funny when we were kind of talking about that aspect of essentially the negativity out there and people feeling it's going to be a bubble.
Joe, question for you. I mean, interest rates, I feel like, are top of mind for everyone, whether you're a buyer, a seller, and you need to buy a new place, agents. What creative financing options are there to even get a lower rate, if any, like versus just a standard conventional?
So when it comes to the interest rates, and there's a secondary on the secondary market, there's an investor coming in that's buying the paper. The rates are pretty straight across the board. When you say something as far as like creative financing, and Ty and I were talking about this, we actually had a deal put together a little while back, a couple weeks ago. But the 3-2-1 or 2-1 buy down is a pretty creative way if you're trying to get seller credits to cover potentially getting you a lower interest rate for the first couple of years of the mortgage. But as far as like as far as the actual I guess what's the word I'm looking for here? A creative way to get a better rate. The reality of it is, like, if you're trying to get a loan on a place and you're taking a loan out via Fannie Mae or Freddie Mac, which is a standard conventional loan, the qualifications are pretty straightforward, right? Basically, they're going to look at your credit scores, down payment, and then the type of property. So it's pretty straightforward. It is pretty much what the market rate is what it is. Now, on the flip side to that, if you're trying to do for example, if you have a self-employed borrower, right, who makes a lot of money but doesn't show it because they write everything off, so they show a big loss, or they don't show enough money to qualify, but they have really good credit scores, and they have maybe they're looking at a $500,000 house and they have $200,000 to put down, right? So they have a big chunk down. That's more of the creative financing end of it. As far as the interest rate goes on something like that, on those QM, they're called non-qualified mortgages because they're not backed by Fannie Mae or Freddie Mac. It's usually like a hedge fund or some other institutional investor that buys that paper. So those rates are pretty set from the standpoint of what they're of what they're basically offering on the street. So if you came to me for that type of deal, or like the self-employed part I just explained, that rate's going to be generally about a point to a point and a half higher than whatever the market rate is on a conventional deal, right? So basically, if you're looking at, say conventional loans on rental units are in the 7s right now, they're a little bit better than that, but let's just use 7%, right? On that non-QM market, which they used to refer to that as subprime, it's really kind of the same, but we don't like to use that word.
Good
but
to know.
essentially it is. But it's not like the old subprime. That's a whole nother conversation. But the non-QM now is really meant for the self-employed borrower who doesn't show income but has a lot of money to put down, and they have a lot of money coming in and out of their accounts, right? So for example, on that type of loan, what they're going to look for is they're not going to look at your W-2s. They're not going to look at your tax returns. What they're going to look at is you're going to want to go back 6 to 12 months of your business bank statements, and then whatever your deposits are, they're going to use 70% of whatever your deposits are. So if you're depositing, 10 grand a month, they're going to use, 7 grand a month as income to qualify. But because they go that route and they don't, verify W-2s or tax returns, they're going to charge a premium for that. Hence, that's why the rate's going to be a little bit higher. But again, you can always use that to get into the property. And then down the line, when rates come down, you can always refinance to get out of it, and go from there. But essentially, did I answer your question? I kind of got sidetracked there.
No, you did. Yeah, you did. And then are you recommending most of your clients now just to refinance once rates do go down?
Yeah, absolutely. Statistically speaking, that the average homeowner will refinance once every 3 to 5 years for whatever reason, right? Whether they're pulling equity out to help a kid with school or whatever the case may or may not be. But yeah, that's absolutely, because my thing is, when I got into real estate and finance, I was 20 years old, right? I bought my first piece of property at 20 years old. The first loan that I wrote for somebody at 20 years old was a 9% rate, right? So they've been a client of mine since back then. And I've done, I took it from 9 to 8 to 6 to 5. And when rates hit 5% years ago, the first time, we were like, wow, we're never going to see this again. So again, renting is 100%, right? That's your interest rate. You're paying 100% when you rent. So, rates, whether they're at 3 or 5 or 7 or 10, like, you just can't go wrong. And that's what I really push people. I'm like, listen, you're paying 100% of rent, right? You're paying somebody else's mortgage. Buy the place, and worst case scenario, a couple of years from now or 6 months from now, whenever rates go down, we'll rewrite the mortgage, right? And even if it's going to cost you a little bit of money, so what? I'll crunch all those numbers and you can determine if it makes sense for you. And majority of the time it does, especially when rates, go down. They say, rule of thumb is 1%, right? The reality of it is, if you have a small loan, 1% or more is probably going to be about right, what you want to drop. But if you have a bigger loan amount, right, it might make sense at dropping at 0.5%. So people that have put in, $400,000 or $500,000 loans at 6.5%, 7%, rates go down to 5.5%, 5%. It's going to make sense for them to do that, to rewrite that mortgage, even with the cost. Because if the recoup time is a year and they plan on being in it over a year, then it's a no-brainer. And that's really what I point out to people. And just buy the place. Worry about rates later. When they drop, you will get a call from me, believe me. So that's yeah. So
yeah, well,
yeah, I think it's super interesting because, like, I think where I want to bring up in terms of discussion right now of what I feel like maybe agents and lenders are having a tough time, because by nature we're salespeople and we earn money based on commission. So sometimes the information that we're getting is from friends, family, interest rates are too high, whatever it might be. But if you're a buyer right now, what do you think the number one objection is? It's prices are too high or interest rates are too high. I need to wait until interest rates come down, right? Like, that's essentially what a lot of people are bringing up this question. But as you guys as the buyer, what's the very first thing you think of? Oh, rates went down, I need to get back in the market, right? Well, you and literally, I think the pre-approval applications right now are down 40% compared to a year ago. That 40% is coming back because that was almost clear, completely driven by rates increasing so fast. So the competition is going to come back as soon as those rates come back down to 5%. I think the whole room would probably agree with that, right? If we went down from 7 to a 5, everyone would feel like everything's on a fire sale and all of our numbers are going to start underwriting again and we can start buying deals again. but that's what everybody else is doing. You know, we've got, you know, about 20 active buyers on the team, and every single person saying, when rates go down, I'll be ready to go. And I say, you and 20 other of our buyers and every other buyer of every agent in this market. And what I had pulled up on the screen real quick was the 2-1 buy down, or the 3-2-1 buy down that Joe mentioned. So like, oh, that's not the right thing. Click this button. So what Joe's mentioned is like, how do you ease the pain? Because as easy it is for us to say, yeah, you just make the payments and refinance in you know 2, 3, 5, 4 years. Well, people have to, you know, make their bills work. That's why we do something called the 2-1 buy down, where it's essentially, it has to be seller or builder paid, and they give you a concession, which is just right here in this box, the $66,270. Literally, what they're doing is they're buying you for year 1 a 2% cheaper rate, and in year 2 they're buying you a 1% cheaper rate. The only way you can get this is when the deal's been on the market for 7 days, 14 days. There's not as much competition because they overpriced their home because they had fear of missing out because their neighbors sold it for this much. I should get this much. Those are the people that this kind of strategy will work with.
So the seller is paying for this as a line item?
That's correct. That's correct. You have to be owner occupied is the piece. So this is more of like, hey, stop me before I get too far ahead of my skis, Joe. Owner occupied house hackers can use this too, correct? Like,
yeah, as long as you're going to live in the property, you can use that on the conventional side and FHA as well.
Yeah. So this is, you know, more of like a house hacker application. Unfortunately, not for anybody, you know, that's buying, you know, deals outside of that. But like, this is a way, like, you can see, you know, this is maybe a little bit high. Like if I change this to, let's call it 250,000, you know, at 5% down, you know, there's some programs out there, you know, let's consider this almost like an FHA. You can see like your payment goes down by $300 almost every single month for the first year, with like $150. Like that's enough to make, you know, deals work, especially for these single family home buyers, to ease the pain for 2 years until they can get that refi opportunity. And right, like what happens in recessionary environments, the Fed drops rates, you know, we'll see a little bit of a snapback because that spread's super wide between the 10-year treasury and the mortgage interest rates. Like, you know, we could very feasibly be down to a 6% to 5% in the next 2 years. We're just trying to ease the pain for everybody. And
one important thing here to just real quick, I'll interject here for a second, is, you know, I saw a post, somebody, a real estate agent had actually posted on social media about how this is a really bad program and how this is going to cause, you know, the housing market to collapse and this and that. And he just obviously didn't understand it. The one thing that they do with this is that when the borrower who's taking this loan out, they qualify them off the highest rate, right? So if the rate is 7% today, for the first year, your payment's gonna be based at 5%, right? The second year is gonna be based at 6%. And then at that third year, if rates haven't come down, then you're locked in at 7% until you refinance or sell the place. So, but when they qualify for an underwriting, they use the 7% initially. So based on that 7% rate, if that borrower qualifies, then they qualify, right? The borrower that we were trying to do this deal, he just couldn't wrap his head around the fact that, you know, for the first year it was going to be this, the second year was going to be this, and the third year, worst case scenario, was going to go back to what he's qualifying off of, because based on his qualifications, he qualified for the loan, no matter how you dice it. So it's really important that they kind of understand that, because, you know, again, they're qualifying them off worst case scenario.
Yep. Cool. Yeah. So that's probably like the one creative thing that's going on right now in terms of getting buyers in under contract. You have to find, you know, in this super inventory, dilapidated market, you have to find that deal. But if you can find that, I mean, this is definitely helping a lot. Like for the inventory is climbing in the Milwaukee market in like the $500,000 and up bucket, you know, higher price point, because interest rates have a higher impact on monthly payments, the larger loan size you're taking out. So I've seen a lot more of these opportunities for those buyers, but, you know, unfortunately, a lot of those buyers are usually right around like the age 30 to 40. And they all are like, well, yeah, it's about to crash. I'll just wait till then because I lived in 2008. So it's like, you know, not to be like, you know, ages, but like they were the ones that got hit the hardest at that point in time. They got to experience the first time, which, you know, I was, you know, carrying my,
your backpack,
my textbooks, wrapped in, garbage sacks around class. So you
guys are making me feel really old right now.
Yeah. So, well, we got 5 minutes left. I mean, any last comments anybody's got? You know, I definitely want to get everybody out on time. I think Razan, I think you're almost at 9:30 your time, so I want to make sure I get everybody out in time. Anybody got any last pieces?
I was just gonna say one thing to the interest rate
Well, I do have a
conversation.
question.
Oh, you go,
Perfect.
Rosanna.
Yes, what's the ratio between single family houses, co-ops and condos? Because for example, here in New York, I tried to buy a condo and it was like extremely difficult. Like for the most part, everything is co-ops, and that is for investing purposes, that was like not ideal.
Did you say co-opt?
Co-ops?
Like a homeowners association sort of thing?
Mm-hmm. Yes, for the apartments. So for the most part here in New York, all of that is like a stock, yeah, like a co-op, that's the name. And like 90% of the inventory, they have it like in that figure. And the condos that you can like rent and use for business, the percentage of those that you can find is like very small. So I
Yeah.
was wondering, like in Milwaukee, how does that work? Or if for the most part is like single family houses or other kind of properties.
Yeah. I don't have a percentage for you in terms of like what amount it is, but there's a lot of buildings that have essentially like rental limits where we will allow 50% of all units to be rented out. That's the majority of what we see in our condo space. And there's a lot that don't allow renting in any case. And the majority, I would say, don't allow short-term stays shorter than 30 days. And some even have rules as like nothing shorter than 6 months was a condo I sold recently even. So
Yeah. So correct me if I'm wrong, Ty. I'm reading it what a co-op is because I'm kind of curious about this.
yeah.
Defined as a building jointly owned by a corporation made up of its inhabitants. So when you buy into a co-op, you're not purchasing a piece of the property, rather you're personally buying shares in the corporation that allows you to live in the residence. And so I don't even have those in Milwaukee.
Is that more like where it's like a 4 flat because you'll have like a 5-story building and each person owns like a level, almost like if it was a 4 family, but you can own a fourth of that 4 family. Is that like a similar
large building in a big city like New
Well,
York?
there are entire buildings that are full of co-ops. Like it's a building that has apartments, but you cannot own your apartment and do whatever you want with the apartment. For example, renting it out, but you have to live in there, and yeah, you kind of like don't own the apartment. It's like owning stocks.
Yeah. Interesting. Yeah. It sounds like it's just like a different formation.
So then for the most
Own something like that. Yeah, it is like they said it was you essentially buy it, but you don't own it. You own shares of the property. So when you sell your shares, but you get a space to live in and do whatever you want.
Is it kind of like is it kind of like the Picasso thing, like the short term or like the shared vacation home sort of project, except for this is huge buildings, like same idea. Like yeah, we don't have that in here in Milwaukee, I don't believe. At least not that I'm aware of.
And what's the difference in prices between single family homes and apartments?
Yeah, I think so. Single family homes I know is like right around the $300,000 range. And I don't think condos are too far below it. I mean, I could probably pull it up on the screen, but I don't want anybody to see me sifting through my emails to find it. I can follow up. It's not too far below, but it totally depends on where you're buying the condo. I would say if you're thinking of renting out the condo, you're most likely going to want to find one near downtown, and I would say those sit around 250 to 300,000, which to you probably sounds like an awesome deal for like a 2-bedroom, 2-bath condo. So.
Yeah, when I started to look for the second property, like at the beginning, I wanted to transition from a single family house that was my first property to a multifamily or like a second family house. But because the prices skyrocketed, I had to start looking for apartments, which is not what I wanted at the beginning. But like at least in this market, the prices between apartments and single family houses do vary a lot. So you can find condos for 200K, but single family houses start at 600K,
Right.
and then like from then on.
Wow.
Mhm.
Yeah. Interesting. Aaron, I know you had something too.
Oh, I was just going to chime in on the interest rate conversation. This will only take 30 seconds and then over you went. But I was just going to say interest rates do suck. There's no way around that. And I'm playing in self-employed land, so I would love to be at a 6%, 7%, but I'm at 8 to 10, which sounds absolutely crazy. But you know, that's just part of it. What I will say is, you know, on the silver lining side of the equation, I guess I've kind of looked at it from the like, you know, I accept this challenge side of the fence. And if I run numbers and something works at 10%, I know it's not just a deal. Like this is a killer deal because, you know, and back to the point of like, you know, get it, just go ahead and get this thing if you can make the numbers work. Because I'll run them two ways now. And I used to never do this before, but I'll run them at my 9 to 10%. And then I'll run it at, you know, 6, maybe 5% if I'm being super dreamy. You know, and I see what that spread is, and I'm like, hey, can I live on it at this 10%? Like all the properties I'm going for right now, you know, I'm running them at 10%. I'm like, if I'm okay living on it for, you know, I'll say 3 years just to be super conservative. Hopefully it's just a year, but if I can live on it for a couple of years at that 10%, you know, this is a long-term game. You know, and a lot of these properties, just at a refi, I'll make another $500 a month just for doing absolutely nothing. You know, if it works at 10 and I can drop it to 6. So that's thing number one, you know, challenge accepted kind of mindset. And then thing number two is because I'm trying to do these syndication deals, I'm talking with investors a lot. And that's probably their number one question is like, oh, these interest rates are terrible. Like, is there even deals out there anymore? And I tell them the same thing. I'm like, if I can go lock something up at 10%, that means it's a killer deal if it still cash flows at that, because it's really against the grain. So you know, they like that answer, which, you know, it makes sense, and you can only kind of go down from there. I mean, if they go up past 10, I'm just gonna be eating my words, I guess, and I think we all will be.
Or something, Aaron, that we don't know. So yeah, that's what that person's thinking when you walk away, right? Well, you're different. So
yeah, exactly. Yeah, and you know, I tell the investors too, I'm also like, you know, in real estate, time usually solves all problems because everyone's always like, what if the market changes and what if the interest rates blah? And I'm like, I mean, you know, for my syndications, it's why I'm like, this is a 5-year hold. Like in my mind, it's a 2 to 3 year hold, but I'm going to tell you 5 years. And so I think I bring that up here because I think a lot of this is an expectation setting game, not only for me setting expectations for investors, but us setting expectations for ourselves. And I think that's why I'm like, can I sit at 10% for 3 years? I'm setting my own expectations. And if the world shapes up better between now and then, that's bonus territory. But, you know, thinking the long game.
agreed. Awesome. Anybody else got any last bits? I'll make sure we all get home and tucked into bed.
Yeah.
I'd really appreciate it. Again, shoot me an email that you guys came. That way I can kind of get like a guest list who came, because I know there's a couple people who wanted to get connected. In that email, like give me some feedback in terms of what you liked, what you didn't like, all that good stuff. And you know, if you guys have like other investor friends or whoever that might be interested in the Milwaukee market, like I think we're going to do this again next quarter, you know, next 3 months or so. Definitely invite them. I'm going to post this probably on YouTube just so that, you know, there's a lot of investors that wanted to be here but couldn't just because they're events. And, you know, I'll definitely connect you guys. You know, there might be you know, something that gets you know, a good connection that you guys get just from, you know, other people in our network here. So please send me an email. I'd really appreciate the feedback. This is the first one we've ever done this way, but you know, hope you guys found some value in it.
Yeah, thank you. I appreciate this. I appreciate all you being on there. You know, Aaron, Joe, Rosanna, you guys have obviously a lot more experience than I do at this. I'm new to the game, but I appreciate, you know, the input and your insight, and gives me a lot of hope for getting some deals done and getting this off on the right foot. I appreciate it.
It was nice meeting everybody.
Yeah. Likewise. Thanks, guys. And thanks, Ty, for putting this together.
Thank you, guys. Thank you.
I'll see you all soon.
All right, cool, guys. Have a good night.
There you go.
Nice. Oh, there's us. All right.
That person.
That's what we look like.